and welcome to the Tearsheet Podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. I'm Tearsheet Editor-in-Chief, Zach Miller. And the traditional lending officer is facing their biggest disruption in decades. AI isn't just entering financial services, it's reshaping how we evaluate credit risk and make lending decisions. And this tension between human judgment and algorithmic precision is the latest focus in our ongoing AI series exploring how artificial intelligence is impacting financial services. Joining me today are Jonathan Kolozsvary, Global Head of Small Business at Visa, who brings insights on how transaction data can unlock lending opportunities that traditional credit models miss, and Patrick Reily, co-founder of Uplinq and Malcolm Baldrige Award recipient, whose AI predictive models are already being used by the Federal Reserve. And together, we're going to tackle a critical question. Are we witnessing the evolution of the lending officer? Or are we approaching a future where algorithms handle what humans have done for generations? And the answer will shape the future of lending and the broader relationship between tech and trust in financial services. Welcome, gentlemen, to the podcast.
Good to be here.
Thank you.
Patrick, we'll start with you as an early AI pioneer in financial services whose work's being used by the Federal Reserve, I mentioned. How do you see AI fundamentally changing the role of traditional lending officer? Is it fundamentally changing the role of the traditional lending officer?
Well, it's interesting. I would say, AI is already here. Sort of what we have is this interesting window in time where the math is here. The traditional lender is sort of a herd-like animal, right? They all like to move together. There's safety in numbers, and so we're working through that adoption curve. I would say the other thing that's interesting is there aren't many people who understand AI well, who also understand banking very well. Mm. And your AI is never any better than your objective function, right? And honestly, the objective function in finance, in lending, is actually quite complex. You're balancing various interests of regulators and lenders and the actual borrower, the community, and so on and so forth. But in small business, the gap is enormous. I think it's very important to keep in mind that if we look at consumers, the credit bureaus would estimate that only about 15% of consumers are underserved. When we look at small business makes up 44% of the US economy, as an example. And that holds true. That ratio is close to that globally. But only about 2.5% of loans on bank balance sheets are small business loans. And so it's really the last greenfield, and it is because it is so complex and labor intensive. And this is where AI really begins to solve very, very serious problems. And so, but what everybody has to work through is the process of adoption. How do we make sure we check all the boxes well? How do we make sure we get that objective function right, satisfying all the stakeholders and so on? And that's what's happening. And it's very exciting. At this point, we've underwritten about 1.5 trillion globally in small business loans in markets as big and well-developed as the US, and in marketplaces that are as challenging as, say, Nigeria, Bangladesh, or the Philippines. And so the process that we're talking about here works globally. I think that's a really important point. The process of collecting data works globally. Is data different from place to place? Is regulation different from place to place? Certainly. But these tools are applicable everywhere. And one just simply has to be mindful of what the rules of engagement are, or how you have to play in a given space.
I just want to double click on that, Patrick. So you mentioned in part of your answer that there are not a lot of people who are generally expert in AI and financial services. And I'm curious, as we go out on that maturity curve, the adoption curve that you described, are we seeing more of those types of people?
I think we're certainly trying to push forward on it. It's fascinating. If you would go into Equifax or TU or Experian in the US, you're going to find very few people who've ever made a loan. If you go into the GSEs like Fannie and Freddie, you're going to find very few people who are building the models who've ever done that. My personal background, I started overseeing loan programs with people like JP Morgan Chase going all the way back to the 1980s. So yes, I'm a very old goat, but I think importantly, this ability to look at it in a complex way is what makes all the difference, right? The math is the math, but the ability to say, we need to be concerned about the regulator. We need to be concerned about the shareholder. We need to be concerned about the borrower's interest and the underwriting interest of managing credit risk. And we need to be thinking about fairness and inclusion. It's the bringing of these things together that drives some of the expressions right over my shoulder. I mean, this stuff is game theory. Game theory says we have these complex interests all sitting at the table, kind of competing for each other, right? And now we need to find that spot in the middle where everybody's happy. And that's what AI does really, really well. Human beings typically tend to want to optimize on one objective function. But the AI doesn't have to get emotional about it. It can continue to look and say, how do we uphold the interests of the regulator? And how do we uphold the interest of the shareholder at the same time and find that space in the middle where everybody's satisfied? Did I answer your question, or did I wander off course?
No, totally did. You weren't an AI model hallucinating on that one. Jonathan, I want to punt this over to you. With Visa's visibility into small business transactions, how are you guys leveraging AI to enhance lending decisions for small businesses that might be overlooked, the way Patrick mentioned?
Yeah, thanks for the question, Zach, and happy to be here. I think for the audience, I'll clarify just a couple things. So one, like Visa doesn't actually do underwriting and lending. We're not a bank. I know you two are aware of that, but our job really is to enable our issuer ecosystem to offer working capital in an optimized way, right? And that vehicle for us is our credit product, and in the business segment, it's a credit card. We often see some of the number one and number two reasons for failure of small businesses is access to working capital. So a lot of what Patrick said, right? The appetite and aperture for issuers to lend. And then the second, honestly, is cash flow management. And so once they have that capital, how do they understand the balance between inputs and outputs, buyer supplier payments, and put themselves in a position to really maximize their probability of success? Your question relative to data and what Visa is doing, we certainly have the ability to view our transactional data, what it offers from what I would say a real-time view into how a small business is transacting. But for me, where AI plays a major role is honestly identifying those signals. And so, Patrick talked a lot about that the math is here. It also comes down to then a word that I tend to use, which is like the applicability of that. And so
Absolutely.
It's historically been a traditional underwriting model for the right reasons, by the way, because small businesses can be volatile, economies can change over time, has really only viewed small businesses either on their consumer history first with a thin or flat file, or as the small business grows, what I call like static or transactional data alone. When in reality, a small business owner and the ebbs and flows of their cash flow is really predicated on more market dynamic data. So that includes both their ins and outs of buyer supplier payments. It includes what I would call macroeconomic factors, alternative data sets, things that Uplinq and other providers in the ecosystem are trying to enable. And so for us at Visa, it's a little bit of overseeing those kind of concentric or overlapping circles. We've had traditional credit bureaus. We've had traditional bank data, open banking as an example of leveraging that to create the aggregate of that. It's how do you take the information at a foundational level, leverage AI as a capability, and then design the use cases for applicability. And so that's where us as Visa are looking both with our internal data structures, partners like Uplinq and others. And I will tell you the resounding kind of theme I hear globally, whether it's India, Singapore, I was in Brazil, Dubai last, is almost every issuer asks the same question. How can you help us be better about our underwriting functionality and capabilities to really open that aperture and lend more?
So going back to you, Patrick, given your background in creating predictive models, how can AI incorporate alternative data sources to create more inclusive and accurate lending practices, especially for these thin file or no file borrowers on the SMB side?
I think Jonathan created a really great framework in describing how we sort of approach this the data portion of this, right? There are two pieces, right? Data you can think is the feedstock or the fuel, and then the math is sort of the engine that it's dropping into to drive something. And in this case, it's good for people listening in on the podcast to keep in mind that if we're thinking about the consumer space. Most credit reports and trade files are long. They're relatively long histories unless you're dealing with a 23-year-old. In small business, the average age of a small business is about 3 years. And so if you build a paradigm that's based on a credit report and based on perhaps some financials, you immediately bump into what I would call two problems. One is, as Jonathan mentioned, a thin file. You have relatively few trades populating in that gives you any kind of reasonable information. And the other is this very brief history short. There's one third component in that, and that is that the data is oftentimes very irregular. Sometimes I have a piece of information for a customer, sometimes I don't. Sometimes I look at the piece of information I do have, and I question whether it's actually reliable. I ask for an income number, meaning I wanted to know the profitability of the business. I get a number that looks more like revenue. We can't expect that very good, very accomplished, very successful small business owners oftentimes know the differences between assets and income. And so when we reach broadly for this data, part of what it lets us do is really achieve two things. One, fill in the missing pieces when I don't have information. The Visa transactional information is very useful for that. Statementing information is very useful for that. Recurring bills, these kinds of things that show us the kind of activity. Marketplace information from places like Amazon and Alibaba and so on, all help begin to fill in that picture. The other thing they let us do, though, is it lets us cross-validate. Are A and B telling the same story? Now, the fascinating thing, and one of the most important things, and Jonathan already raised it, is if you try and understand the behavior of an organism, whether it's a small business, whether it's a corporation, whether it's a salamander or whatever, the only way you understand this stuff is if you first consider the ecosystem that it's in. And amazingly, if I look at almost all the major scoring producers, whether they're rating agencies or bureaus or other technology companies, virtually none of them consider the ecosystem. I need to ask myself, why are they reacting the way they are? Are they demonstrating wisdom about where the marketplace is going? Are they demonstrating creativity about how to react to competition and so on? That actually explains about 1/3 to 1/2 of all credit risk variability with small businesses when we include the ecosystem. So we have an ecosystem, a business behavior, and the actual loan decision that we're trying to make as part of the overall understanding. It's probably a longer answer than you wanted, but it's important to understand.
No, so when you mean ecosystem, you're talking like the supply chain, I guess? Upstream of the business?
Think about what's happening with their customers, what's happening with their competitors, what's happening with their suppliers. Think about stuff going on with trade. Think about what happened with COVID, the changes in oil prices and so on. This explains a lot, but it also exposes the expertise or the vulnerability of the individual small business owner. It helps us understand. Another aspect that you can think of when you think of ecosystem is how well are they connected to entrepreneurs and other peers, but also mentors, people who've been down the road they've been down, who can provide really great advice. This kind of information really helps us improve our understanding of their credit worthiness and their likelihood to succeed. Because oftentimes, if you think about a credit report, it's only looking at lending histories. What we really want to do is understand what is the likelihood that this business is going to thrive and grow and succeed and therefore have the capital that's necessary to repay the loan. That's really what we're trying to get at. Now, the other important piece I would make about this is everybody's a winner in this process when you do it, right? So not only is the borrower winning, not only is is Visa, the financial institution winning, but the whole economy grows, right? Remember that capital drives economy. And if you're starved, if you go back to that 2.5% number, if you push capital in, you actually grow entire economies. And that's why we've been working with the World Bank since about 2014.
Jonathan, I want to go over to you, and obviously keeping in mind that Visa is not the lender at the end of the day, but I'm kind of curious. We've done a lot of talking about SMBs and consumer as well, and on the lending side in terms of like reticence or resistance to taking on AI. I'm kind of curious what you think. What resistance points have you observed when implementing AI lending solutions within traditional financial institutions, and how are you helping banks overcome some of those barriers?
Say the first is education and awareness.
Mhm.
So I think Patrick made a comment, which is, it's rare you find AI subject matter experts who also are financial services experts, and the inverse.
You're probably
People are
speaking to all of
upskilling.
them, Jonathan. Yeah. Yeah.
And what I would say is, like, people are upskilling though. And so I think there's a wave of kind of this, agentic AI evolution that is putting all of us in a position to say, how can we be better? How can we understand this more? And so what I would say is, I've rarely walked into a conversation where I've seen a bank or an issuer or a partner say, I know nothing about this. Typically, they've done their own research. They've even had internal discussions about where their potential risk appetite might be and their ability to adopt. And then also what I would say is actually leverage the information. So it's one thing to say, hey, I am happy to adopt agentic or artificial intelligence or Gen AI to help me. It's another thing to then say, I'm going to deploy it and I'm going to utilize
Absolutely.
it on a daily, weekly, monthly, annual, whatever the cadence is basis, to then hit a very specific KPI. So when I have a conversation with an issuer or partner, typically we start with, like, what was the original state of your lending process? And it depends, but you'll see things that are very linear or sequential in order: intake of information, typically financial statements, running through a model that's been predicated based off of, by the way, regulatory pressure, but also a bank's appetite for risk. And then it usually populates, right, an end result, things like a probability of default or a loss given default score. And then in that chart, right, there's the applicability of lending at a certain threshold. When we talk about what that current state is, and then we suggest what's needed to get to that destination state, leveraging AI, you do see it doesn't fall on deaf ears or blind eyes. And so one of the things that I know Uplinq has done, partners within that ecosystem, and that we're trying to explore is, if you run applications through that originating model that you established at first, and you get a certain throughput and then what I would say approval rate, what if we layered on both this foundational data that we've spoken about here, leveraging artificial intelligence to see if that throughput and approval rate improves? And what I would say is, lack of a better term, the proverbial proof is in the pudding. When issuers and partners see that, their appetite, their comfort, their confidence becomes greater. And the last thing I would say is, coming from the banking industry, it's as much a bottoms up. So the sense of, like, those that are boots on the ground, whether it's, tellers in a branch, whether it's managers, relationship managers, you name it, is as important to advocate and understand as it honestly is from the executive level down. And so when you do that meeting in the middle, you have the, what I would say, ambassadorship of the total organization, and outside partners like ourselves, Uplinq, and others who hopefully can be viewed as trusted partners to come in and co-author, co-develop along that journey, and not leave an issuer or a bank on an island to discover it on its own.
If I pivot off of something you just said, I think there are a bunch of important points right there, but always keep in mind, and there's probably a lot of bankers, in this audience, but the underwriting organization is a risk-averse organization, right? The mindset is concerned about making mistakes and staying within compliance and so on and so forth. It's one of the reasons why we don't ask anybody, we think there's so much hype in the AI space. We don't ask anybody to believe it. We simply come in and do a proof. We actually develop the tools, demonstrate exactly how well they work. And so before anybody takes a capital risk position, they can actually observe the improvement that it makes. And I think Jonathan hit the 2 points. One is the ability to manage credit risk within a regulatory paradigm well. The other is to simply reach more. Virtually everybody, it's very, very unusual to find anybody who doesn't want to grow. And I would say the same holds true for actually reaching underserved segments of the population. Typically, the thing that has held them back is their lending where they feel safe. If you can demonstrate to them the capability of reaching underserved segments, virtually all of them are very engaged in doing that well. And so it is this process of stepping through, demonstrating competence, capability, and then, to Jonathan's points, it begins to transform and sort of educate and get everybody on the same page within the organization. And that's really where you see inertia in moving forward and doing really transformative things.
Zach, can I offer a real-time example that we're facing with a small business segment? And I don't want to deviate from the lending
let's do it.
So if you think about, and I've been pretty vocal about this, so is Visa, and very declarative in our support for the creator economy. This is consumers who are turning, right, their passion into a profit. And so they're the next stage entrepreneur, right, powering the digital economy. So when we talk about GDP, we talk about infusion of capital, like this segment is growing at a massive rate. Now, it doesn't mean that it's going to cannibalize, the baby boomer generation of small business owners or other segmentation within small business, which, by the way, is not homogenous. We know it's vastly diverse, but it's growing the pie. If you think about this segment, it's relatively foreign to traditional issuers and banks because they are consumers transitioning into this social media platform selling of my content. So this isn't I have a brick and mortar around the corner. I can prove to you that I'm making bicycles and those are being sold at a certain rate.
No widgets here. Yeah.
None, right? We're talking about even leveraging like non-fungible tokens, right, for monetization and applicability of what the content purchase looks like. And so for us, it's critically important to say if this is an ever-growing segment, to Patrick's point, and you want to reach that segment, how you support that segment through an underwriting functionality and capability is critically important. And we're at the early stages of discovery with that. But a large part of it, when I mentioned that co-authorship, is both with the issuer and, frankly, the end user. So understanding those behavioral aspects that Patrick talked about, like why and when they make decisions and what that means for the institution to get more comfortable. Now, to be clear, and I agree with this, like issuers' jobs and banks' jobs is to offset, mitigate risk. It is also to help grow the economies, and small businesses are the backbone of that. And so if you strike that balance, they're eager to innovate, but also as hungry and thirsty for the information to be able to do so.
Yeah, I think what he's underscoring here is that concept I mentioned earlier about game theory. You have to respect the interests of all the participants in the process and build AI that is consistent with that. In other words, we a couple of years back here, we actually sat down with the Fed Reserve and explained what we were doing. At that point in time, the Fed Reserve was very risk averse about stepping into areas of AI because AI traditionally has had problems with things like transparency. Well, if you need to understand if a bank is making a good credit decision, you have to be able to see what you're doing. The banker darn well better be able to explain why the model does what it does. And so part of the build concept out of that then is to make transparent models. You use AI in the background to drive these very powerful things, both looking and saying, how do we be fair? How do we be inclusive? How do we satisfy safety and soundness? But also, how do we make a profit for the shareholder? How do we do something that's accretive for the borrower? How do we grow the economy? And when we bring all these things together, the systems are infinitely better. Actually, infinitely is a big word. Far better at making these kind of complex decisions than humans are, because humans will tend to prioritize one objective much higher than another. It's just human nature. And so by being able to hold all these things in tension and find the spot in the middle, we really get to a much more effective decision. I think the other thing that happens in this process is something that oftentimes takes weeks within a traditional bank underwriting process. 99.6% of the decisions we make happen in 2 seconds. What that does is it drives an enormous amount of cost out of a process and allows far more efficient decision making to small business. And that simply makes capital flow where capital didn't flow before. So it's getting this right is big stakes for banks. It's big stakes for economies.
Patrick, I like how you said we don't ask you to believe anything, we show you. It's not a religion, AI. And I guess I just have a meta question for both of you. And are we going to be having these same conversations 2 years from now? Is AI like as a standalone thing that people are thinking about incorporating, or is it just going to be ubiquitous? Like, is this just the growing pains, the early days of it?
I would say that it is growing pains. I mean, for me, there's a bit of a comedy. I created some of the first commercially viable AI all the way back in the mid 1980s to better manage the U.S. power grid. And so for me, this long journey and then somebody standing up and saying, hey, AI is important is really sort of comical almost. And however, I think computer resources and data availability have literally exploded. We collect right now about something in the neighborhood of around 30 billion data series globally, right? Think about 30 billion. If you were going to try and make a decision about whether one of those pieces of data was important, and you could make a decision like that once every second, it would take you 951 years to get through it. And so what AI does is it makes something tremendously complex, comprehensible, and fast. Now, an important part, though, is when do you want humans in the loop? I think a really smart design concept within AI is humility. How do you bake humility into a system? So it puts up its hand and says, I don't know, or we're not in Kansas anymore. And you really need to bake into this a process, because the intersection between humans and AI is where you really get the magic. You get this human creative insight that's happening, while at the same time you get this ability to plow through vast amount of data and say, how is this stuff important? And the intersection of those two things is actually really, really valuable.
That's a good yeah, please, Jonathan.
I was just going to say, if you look back at the history of innovation, right? When the computer was introduced, the hypothesis was, well, people aren't going to need paper anymore, right? All of a sudden, and maybe this is just close to my heart, living in Rochester, New York, with Xerox and the likes of Kodak's, like the inverse occurred, right? When people had computers, they developed printers, and when printers were developed, people were printing documents more than ever and using paper for all of that. And so these industry norms and this innovation waves have occurred historically. And I think we've seen that at first, there's always a little bit of an adverse reaction to it. It's I don't know what I don't know. I need to be educated and aware.
Sure.
But in the day and age we're in right now, where the consumption of information is at a completely accelerated rate, any and all of us have the answers at our fingertips, whether it's ChatGPT, whether it's, another tool or resource for you to get educated and aware. So I think what you're going to see is a bit of an acceleration on the learning curve. You're still going to have, rightfully so, right, the conservative side of things to understand, hey, how does this change or adopt or adapt, right, what it is I do today? But frankly, I don't think it's disintermediation. I think it's acceleration. And I think it adds value to those who are in the jobs today to actually have them do more tasks that are of higher value and create economies of scale that weren't there before.
Did you have something to add to that, Patrick?
No, I was just going to say, when you mentioned disintermediation as well, this issue of sometimes, how do fintechs interact with banks is an interesting aspect, right? Because historically, what we saw was this: fintechs are going to try and take on banks. Now, much more what we see, and if you think about that, that's a silly notion, right?
This was actually a line of reasoning that we never took at Tearsheet. Like, it was never the big guys versus the little guys. And a lot of media played that out, but it didn't make any sense. I agree with you.
It didn't make any sense, right? A bank's capital costs 1%, right? It's really, really tough to compete with that. And what you have now is much more collaboration. The kind of work that we're doing with Visa, the kind of work we do with some of the biggest banks around the world, and some of the smallest as well. And really taking advantage of what they do very, very well, and then equipping them with the tools to then reach deep. And this is what Visa does very well. Visa looks and says, yeah, we're not the lender, but we can help them do what they do in a much better, much more effective way. And this kind of partnership, I think we're actually, in the banking industry, we're actually getting much, much better at this.
Yes.
How do we collaborate and sort of marry together these skill sets or unique data availability and so on and so forth? And I think this is a very positive thing.
The ability to partner at scale and speed, I think, is a differentiated skill in the
100%.
financial services industry. And that kind of brings us full circle as we're getting near the end of our conversation. I'm curious for both of your opinions. Coming back to this idea of an autonomous lending officer, that sounds like a scary proposition. I don't know if we ever get there. It's not even really the point, but I'm kind of curious how you guys would advise or consult financial institutions, traditional ones, in terms of rethinking of the lending officer role and how to come up with a technology strategy to get their hands around all this. Because a lot is changing, and it's changing really quickly.
Yeah. I stepped onto a G20 stage a couple of years ago, and they introduced me as a fintech. And I started my statement by never believe anything a fintech tells you. They're all liars. Make them prove it.
Lying with numbers.
And I saw this audience of about 2,000 bankers, and all their heads were nodding up and down. And so prove it is an easy thing to do if your stuff is good. And prove it is not just systematically or globally. Proving it is for that particular lender, for what they're trying to do, the market they're trying to answer. And I think that's a very important part, that you can actually fit this within the regulatory paradigms and so on. I think we're in that phase right now. It is unreasonable to imagine that a typical banker with all their expertise is going to appreciate the math. And so what you really have to do is give them demonstrated proof. Most people, turn on the engine of a car and drive away without understanding much about internal combustion. And I think that's the process we need to get through. People need to understand that the technology is reliable, that it satisfies all the requirements, and so on and so forth. And now we're right in that awkward stage where a few brave bankers are starting to do it and try it and work forward. And because of that sort of herd mentality, you get adoption. And then it'll grow relatively quickly beyond that point.
How about you, John?
I'd say that historically, we've used deductive reasoning as to why we do things. I can only do X because Y is in place. And as we mature through this evolution, I think inductive, even abductive reasoning becomes kind of the origin state. And what I mean by that is, let's look at what the current model is today. But if we designed it without constraints, with the end user in mind, whether that's a mature SMB, an evolving SMB, a new SMB, right? An entrepreneur getting into business, and then think about what the way forward is for them to get access to capital, all while maintaining the ecosystem parties we talked about, we'll see a different model. And I think if we encourage and act as partners, right, with our issuers and banks in designing that process, you're going to see an evolution of underwriting. You'll see an evolution of what I would say the resources that were originally allocated to it and what their role is. Again, not disintermediated, but of higher value. And I do think there's the ability for us to work with all parties, both banks, issuers, regulators, you name it, in a way that allows us to better understand that with this information, we are all more powerful. And that does nothing besides benefit both the SMB, the issuer, and the overall economies that they serve.
That's, it's a really great insight that he's making there. And the way it gets expressed in AI is you see the model nuance itself actually into multiple models. How do we underwrite women-owned businesses in traditional Islamic countries that may have restricted the flow of capital into female entrepreneurs? Or how do you reach nascent businesses? And fundamentally, what we see is these models look different than well-capitalized, well-established. How do I lend effectively into CRA zones within the US? These models look a little different. They prioritize data differently. They look at other notes that demonstrate expertise. I talked about that, who are your mentors, right? And in Brazil, we have the entire business registry that goes back 20 years. We can see the connectivity between a new entrepreneur and the lineage of expertise that he has access to. And that allows us to lend much more effectively into a space because he has a safety net, a social net of expertise around to help them succeed in doing what they're doing. So this incorporation of information is able to be nuanced very quickly to attenuate to various subcategories, various lender requirements and objectives, changing marketplace conditions, and so on. And so that is one of the beauties of it. One model is effectively replaced by many, and those models are tuned very well to take on challenges that typically a banker simply couldn't afford to address. They had to focus on the core and not meet the edges.
Well, we're definitely living during exciting times. Patrick, Jonathan, thanks for joining us on the Tearsheet podcast today.
Thanks for having us.
Pleasure being here. Thanks for having us. Take care.